Welcome to the debate. Before we start modeling the market's trajectory, we should acknowledge that today's discussion is brought to you by VirPoint. If you're listening to this show, you know that having a thesis is only half the battle. The other half is all about execution. VirPoint is a CFD brokerage that's really built for the modern trader. They combine human insight with some pretty advanced AI tools to help you navigate volatility and express complex market views with precision.
And it's probably worth clarifying, VirPoint specializes in contracts for difference. So this means whether you're looking to go long on equities or maybe short indices based on some of the risk we're about to get into, their platform gives you the leverage and the tooling to act on that analysis, and you can do it without owning the underlying asset directly.
Right, which brings us to the analysis at hand. The central question for today is big, it's provocative, and it's a number that, well, it scares a lot of bears. Can the S&P 500 plausibly make a run at 7,000 in 2026?
That is a massive number. It feels psychologically heavy, doesn't it?
It does. And look, we know round numbers like 6,000 or 7,000. They act as these psychological magnets. But we're not here to do numerology. We're here to debate the fundamental mechanics, the framework required to actually get there. I'm taking the position of the advocate today, and I'm going to argue that there is a coherent, even a mathematical framework where a specific combination of AI-driven productivity, easing interest rates, and a significant earnings expansion makes 7,000 not just a dream, but a probable scenario.
And I, of course, am the dissenter. I look at that exact same framework, and I don't see probability. I see fragility, extreme fragility. You're describing a perfect storm of positive variables, a trifecta where everything has to go just right. My argument is that for the S&P to hit 7,000, you need an operational environment that is historically just incredibly rare. So I'll be highlighting the tripwires, the macro shocks, and valuation compressions that I believe make this path much, much narrower than the bulls are willing to admit.
Okay, let's get right into the position statements then. I want to be very clear about this. The path to 7,000 isn't about blind optimism or, stonks go up. It relies on three specific forces, and they have to reinforce each other. First, the AI trade has to evolve from hype to tangible CapEx, capital expenditure, and productivity. We're seeing that happen right now. Second, we need a less restrictive rate backdrop. We need the Federal Reserve to step back and let valuations breathe a little. And third, and this is the engine room of the entire thesis, we need earnings to do the heavy lifting through operating leverage. If those three align, the math works.
If is doing a tremendous amount of heavy lifting there.
Well, markets are always about if and probability, but my point is the market has momentum. We have to respect that. The market mechanics, the flows, the positioning, the narrative dominance of U.S. equities, they create a self-reinforcing loop. As long as the earnings data supports the AI narrative, the multiple holds, systematic strategies buy the dip, and the index just keeps climbing. It's a virtuous cycle.
I appreciate the optimism. I do. But let's look at the statistical reality here. You're betting on a trifecta, and I'm arguing that requiring three distinct macroeconomic variables to break your way simultaneously is, well, it's a statistical anomaly. That is a very high bar. My position is that targets are never guaranteed, and this specific scenario assumes a soft landing sweet spot where inflation dies but growth lives. That is just notoriously difficult to maintain over a multi-year period.
You think the coordination is impossible?
Not impossible, no, but highly susceptible to shock. You mentioned lower rates. In your model, rates fall, stocks go up. Simple enough. But I'm looking at the cause of the fall. If the Fed cuts rates because the economy is entering a recession or because of some kind of credit event, that doesn't boost valuations. It crushes earnings estimates. The valuation support you're counting on only works if the economy holds together. If earnings crack, or if the consumer finally buckles under the weight of all this debt, the math for 7,000, it just evaporates instantly.
Okay, so that's the crux of the disagreement right there. Durability versus fragility. Let's move into the core debate and maybe dismantle these three pillars one by one. And we have to start with the elephant in the room, the AI trade.
The engine of the current rally. An engine that is starting to sputter, in my view.
I disagree that it's sputtering. I mean, the common critique I hear is that this is all a bubble, that it's focused on just a few hyperscalers, the Amazons, the Microsofts, the Googles of the world. But the data tells me the trade is broadening. We're moving from just the chip designers to the picks and shovels phase.
Okay, define picks and shovels in this context, because that phrase gets thrown around a lot in tech circles.
Sure, it means the physical infrastructure, the stuff required to actually run these models. We're not just talking about software code anymore. We're talking about a massive expansion in demand for electrical grid updates, copper wiring, advanced schooling systems, data center construction. I mean, this isn't speculation. These are actual orders on the books for industrial companies.
So you're arguing it's more of an industrial revolution, not just a software boom.
Precisely. It's a productivity revolution. Traditional industries are investing to defend their margins. If a boring logistics company can use AI to optimize routes and cut its fuel costs by 6%, that is pure profit. It shifts the narrative from just a tech story to a profitability story. So when capital rotates out of NVIDIA, it doesn't leave the market. It rotates into the utility company powering the data center or the industrial firm that's building it. And that keeps the S&P 500 buoyant.
I see the logic, I do, but I question the timeline and the return on investment. The source material specifically raises a massive risk here, and it's, quote, AI enthusiasm cools if revenue realization disappoints.
Revenue realization takes time. I mean, the internet took time.
But the stock market is impatient. We are seeing hundreds of billions in capital expenditure. These hyperscalers are spending money like it's water. If the payoff looks thin, if companies spend billions on GPUs but don't see a commensurate jump in revenue, that narrative just collapses. My concern is specifically with the software layer. Are enterprise customers really willing to pay a 30% premium for AI features in their software, or is this just becoming a cost of doing business?
It's probably a mix of both, but the efficiency gains justify the cost.
But if it's just a cost, margins don't expand, they compress. And if margins compress, that self-reinforcing loop you mentioned, it reverses. The passive flows stop, the systematic strategies sell, and the multiple contracts. You can't build a run to 7,000 on a promise of productivity that doesn't show up in the quarterly reports. We need to see the cash, not just the code.
I think you're underestimating how sticky this tech is once it's integrated. But I will concede that stock selection becomes much harder in this phase. You can't just buy the index blindly if you think the software layer is overvalued, but the infrastructure layer is undervalued.
Which is a very valid nuance. The AI trade is not a monolith.
Actually, this is a perfect moment to mention that for listeners who see that specific distinction, who maybe want to go long on the utility companies and the grid builders, but short the overpriced software valuations, VirPoint offers the platform to execute that.
Right, because with CFDs, you can trade specific sectors or even ETFs without needing to buy the entire physical basket of stocks.
Exactly. You can express that precise thesis. You don't have to be exposed to the whole AI bucket. You can target the infrastructure play specifically. If you think the picks and shovels are the real winner here, VirPoint lets you trade that.
A prudent approach, given the uncertainty. But let's move to the second pillar, because this is where I think the bull case is mathematically most vulnerable. Interest rates and the discount rate.
Ah, the gravitational force of finance.
Your framework for 7,000 relies very heavily on lower rates through 2026, supporting higher equity valuations.
It's standard finance mechanics. I mean, when the yield on a risk-free treasury bond goes down, the present value of future corporate earnings goes up. It's the discounted cash flow model 101. But practically it's about Tina Light.
There is no alternative.
Right, but a lighter version of it. When cash yields drop from, say, 5% to 3%, investors are pushed back out the risk curve into equities. You can't just sit in cash forever if inflation is eating you alive and yields are dropping. And furthermore, lower rates reduce pressure on housing and autos, which are huge parts of the real economy. It gives small and mid-cap companies who often have floating rate debt breathing room to refinance. This loosens financial conditions and it broadens the rally beyond just the mega caps.
Okay, I'm not disputing the math of the DCF model. If you lower the denominator, the value goes up. I am disputing the context of the cut.
How so?
You are assuming a Goldilocks cut, where the Fed cuts because they've won the war on inflation. But historically, when the Fed cuts aggressively, it's often because something has broken.
You're worried about the recession cut?
I'm worried about the correlation. Yes, if rates fall because unemployment's spiking or we have a major credit event, the stock market doesn't rally. It crashes. In a recession, earnings estimates plummet faster than the discount rate can possibly save them. The stock market usually bottoms after the Fed starts cutting, not before, so counting on rate relief to lift the index to 7,000 assumes we avoid the recession entirely.
Which is what the data currently suggests. We're seeing inflation cool while GDP remains pretty robust. This soft landing sweet spot, it's holding. The bull case implies that as rates normalize, we don't get a crash. We get a release of pressure. It allows the companies that were choking on high interest costs, specifically in the Russell 2000, to finally run.
Pressure released is good, assuming the tank hasn't already sprung a leak. But okay, let's assume you get your neutral rates. That brings us to the third engine, earnings. Because if rates are just neutral, they aren't really a tailwind. Earnings have to drive the bus from here.
And earnings are the ultimate fuel. For the S&P 500 to sustainably move to 7,000, earnings absolutely have to participate. And my argument here relies on a concept called operating leverage.
Okay, so explain that for the audience who might not live and breathe balance sheets.
Sure. Operating leverage happens when a company can grow its revenue faster than its costs. And companies have spent the last 3 years aggressively tightening their belts. I mean, firing excess staff, closing unprofitable divisions. They are lean. Now, you introduce AI-assisted workflows and stabilizing input costs. If revenue just holds up, it doesn't even have to skyrocket, just holds steady or grows slightly, that efficiency falls straight to the bottom line.
So a 5% increase in revenue could become what, a 15% increase in profit?
Exactly. And that EPS, earnings per share growth, is what justifies the 7,000 level. We're not asking for the price to earnings multiple to go to 30 or 40. We are arguing that earnings will grow into the current multiple. And the breadth is what makes this rally feel real. We're seeing participation from industrials, financials, even consumer sectors.
I'm sorry, but I don't buy that it's that smooth. You're ignoring the external shocks. The source material itself highlights geopolitical shocks, energy spikes, or renewed inflation. I mean, these are massive risks to that operating leverage thesis.
They are risks, yes, but companies are adaptable.
But think about the mechanics of it. Operating leverage cuts both ways. It is a double-edged sword. If energy prices spike because of tension in the Middle East, input costs go up, and suddenly that lean balance sheet is a liability. Margins compress. And regarding breadth, if the consumer weakens, those industrial and financial earnings evaporate. We end up right back in a market held up by 3 or 4 tech stocks. That is not a foundation for 7,000. That's a foundation for a correction.
You're focused on the fragility. I'm focused on the adaptability. Corporate America has managed through 9% inflation and aggressive rate hikes without collapsing. They have pricing power.
They had pricing power. They passed costs on to consumers. That consumer's now tapping out. That pricing power is gone. You can't just keep raising prices when savings rates are depleted.
I disagree that it's gone completely, but it is certainly diminished. However, this tension, this debate between broadening breadth and a narrowing market is exactly why risk management is so important. You can't just be a blind bull or a blind bear.
Which brings us back to execution. Whether you side with the advocate's view of broad growth or my view of a narrow, fragile market, you have to manage that exposure. This is where VirPoint is interesting. They offer the ability to trade across multiple asset classes from a single account.
Right. Diversification is the only free lunch in investing.
So if you're worried about that energy spike I mentioned, that geopolitical shock, you can trade commodities on the same platform where you trade your equities. You can hedge. You can buy oil CFDs to protect your industrial stock portfolio. Or if you think the consumer is dead, you can short the consumer discretionary sector while staying along tech.
That flexibility is key. You don't have to be a passive victim of the macro environment. So let's try to bring this to a conclusion. We've looked at the 3 engines: AI, rates, and earnings.
The trifecta.
From my perspective, the 7,000 number, yeah, it sounds extreme. But when you break it down, it's a story of reinforcing tailwinds. It isn't mystical. If AI momentum keeps capital centered in the U.S. and lower rates help valuations, and corporate earnings provide the foundation through operating leverage, then 7,000 becomes a probability.
It is a stretch, I admit, but is entirely plausible.
And I'll maintain that while it is a scenario, it is certainly not a promise. The roadmap is filled with tripwires. The difference between 7,000 and a major correction lies in the nuance. Do rates fall for the right or the wrong reasons? Does AI revenue actually materialize, or is it just a massive CapEx burn? I think the probability of all three engines firing perfectly without a single mechanical failure is much, much lower than the market is currently pricing in.
And that is the nature of the market, isn't it? It climbs a wall of worry.
Indeed, but I think we can both agree that S&P 500 at 7,000 is a useful framework. Whether it hits the number or not, understanding these three variables, AI, rates, and earnings, is how you understand the mechanics of the market for the next 2 years.
Absolutely. It forces you to watch the right indicators. You stop watching the daily noise and start watching margin reports and bond yields.
Before we sign off, I just want to remind our listeners that if they want to take these insights and turn them into action, VirPoint is the place to do it. They invite you to master the markets and own the moment.
That's right. VirPoint offers CFDs on stocks, forex, and digital assets with razor-sharp precision and no hidden fees. If you want to turn these market insights into smarter trades, head over to VirPoint and create an account.
It's been a pleasure dissecting this with you.
Likewise. Thank you for listening to The Debate. We'll see you next time.